Good morning to all of you from US. Good evening to all of you from India, and also from other countries. Good afternoon as well. My name is Nikhil, and thank you so much for joining us today. Okay, and I will just start with a quick introduction. Yes, anybody wanted to say something? All right, so I will just start with a quick introduction about George, who is company CEO for Alcor Fund, for which we all have come in today, and he's going to take over the entire presentation. And the topic, as you all know, that it's about uh, five funding blunders which we are going to discuss, and we have to overcome them and increase the chances of success. So about George, just letting everybody know that George wears multiple hats. He is also a chairman. He is the president of a group. He is CEO of multiple companies. He is the founder of Alcor alongside our other enterprises and directors of a lot of companies as well. Well, about his education, I think 40 minutes will not be enough for me. But just to let you know, he has completed his education from Harvard Business School. He also attended Oxford. He also went to Cardiff. Okay, and he has about 25 years of funding experience and investment banking with private equity, mergers and acquisitions across the world. Okay, and he has 10 years of experience of managing a portfolio of companies across 20 countries. And I am very happy to say that I am an employee of one of them and very happy employee of one of them. So George has built about companies into billion dollar enterprises, okay, and has of course graduated from Oxford and Harvard, and has brought a new perspective to companies' growth with his completely unique ways to run the companies. Okay, and he is an industry speaker and has addressed the Euro Summit, World Startup Expo, and several global forums. Okay, he has also won many social awards from WHO, UNICEF for his anti-tobacco activities, widow education, orphan education, and care. So he is also actively involved in charity and philanthropy programs. Okay. So once again, welcome all of you and presenting Mr. George Molakal. Over to you, George.
Good morning, everyone, and thank you very much for coming and joining this program. And thank you, Nikhil, for this very warm introduction. I look forward to having a good chat with you this morning. So we're just going to dive straight into a world of 2021 and how to raise funding without the most common five top blunders of funding. So we do have funding, and we always want to look at how do we go about getting our funding. What is it that we need to do to get our funding right? And we all are entrepreneurs, and as entrepreneurs we always have to go about our funding. We have to go for raising capital, we have to go for negotiation, we have to give for the pitch books, we have to go. It's time and time again, 30% of our time as entrepreneurs is always on funding and raising capital for the next project, for the growth, for the working capital, for everything else. So what are the top five funding blunders that we have? So, and can they be avoided? So we're going to look at a few cases where people have not avoided and they have collapsed, and we're also going to have a few cases where people have done it and they have been very successful. So what are these cases and how are these cases? So first is we're going to look at flexibility. Most of the entrepreneurs like to be flexible. They like to be rigid or they like to be flexible. Either you're rigid or you're flexible. Second is, there are so many assumptions. When you start a business, you don't have all the facts with you. You don't have all the scenarios with you. You do not know whether you're doing it right, whether you're doing it wrong, and how do you do it. Then one of the other things is, when you're looking at cash burns, when you're looking at, how you're taking it forward, you're not sure whether you've got your cash burn right. Because either if your cash burn is short, you will collapse. And if your cash burn is too long, investors will not come and say, what's the right way to predict and forecast your cash burn requirements? And then we have risk mitigation. A lot of companies, everybody wants to get inside and run around and raise capital. How are you going to do it without knowing whether you're going to dive into a 10 feet pool or whether you're diving into a 100 feet pool? Have you just checked the depth of the pool before you dive? And what are all the business risks that are there? And then, underestimation, and how we underestimate a lot of things and then we collapse. So I'm just going to dive straight on into the first one. But before we go there, I just want us to take a breath and look back and say, hang on. So what is my entrepreneurial journey going to be? Is it going to be something like, I'm excited, I have a great idea, I think I know my customers, let me go and let me dive. And so everybody comes in for uninformed optimism. That's the way to look at it. And then you just go in straight in and boom, you hit the value of shit. Because you know what? There are a lot of things that is unknown to you at the time when you're founding this company, at the time when you're taking this idea, at the time when you're actually about to run about it. You have no idea. And so you hit this thing. And then it's how you pivot, how you carefully grow, and how you climb out. So it's like, it's not a 1 year journey. It's like a 4 to 5 year journey before the time you're successful. But remember, 90%, 95% of the companies do not even reach 4 years. So what goes wrong? How did they go wrong? There's another way to put the same chart. And, this was published in Harvard Business School, the business magazine there. So you have a great idea and, you leap. So great idea, you leap. That's the idea in leap stage. So you just go straight. And when you leap, you're just expecting, I'm going to be like the next Elon Musk. I'm just going to dive in from here. I'm going to be the next Elon Musk and I'm going to go straight there and I'm going to be the billionaire. Wow, that's a great idea. I mean, that's what we all want to be. You want to be, I want to be, all of us want to be billionaires. So then what goes wrong is because when we start doing the leap, we fall and we land into a pit. And because of execution reality and assumptions reality, market reality, funding reality, all those things hit us and we hit into the pit. Now, if you don't have the tenacity, if you don't have the resilience, if you don't have the focus, you're not going to keep climbing up. So then you keep climbing up and climbing up and climbing to victory. So this is how the climb up is. And this is how the journey of 95% of the entrepreneurs are. So let's look at what's the first blunder. First blunder is we are talking about flexibility. Lot of companies and lot of entrepreneurs have, to learn how to be flexible. I've met with entrepreneurs time and time again. And some of the biggest questions every time everyone asks is, I want to see whether I can become somebody like, Bill Gates or Steve Jobs or anybody. How is it possible? First of all, we have to understand if you're negotiating equity position, and I was in a conversation yesterday with somebody else, and we were negotiating equity, and I said, listen, I'm willing to invest with you if I have 35% equity, and he was saying, I'm willing to give only 10%, and that's the way I'm looking at 10% is what I'm looking at it. I'm not looking at 35%. So, well, I had to say goodbye. I said, because you see, the way I'm looking at my risk is 35%. And if you're looking at only giving 10%, well, I'm sorry, I can't do forward. Now, let me go back one step back and talk to you about, this company, Starbucks. You all know about Starbucks. And what does Starbucks do? When he wanted to raise $3 million, he had to give 80% of his company to raise $3 million. He was left with 20%. 20% to raise $3 million. That's Starbucks. Howard Schultz is now a $123 billion enterprise. He had to give 80% to get that first $3 million to start the company. And because he had an open mind, he was able to take it to the next level. Now, it's not only Starbucks. There's another publisher who came for funding, right? So she made a huge business plan and she put all the capital equipment over there. And she said, I need to buy a printing press and I need to do this and do this and do this. And she had an experience in the publishing industry. So what happened is she submitted the business proposal, and then investors were very, very timid. They said, listen, you're a first time publisher and you want to buy a huge capital cost equipment, and that's worth, a couple of $1 million. We don't want to fund you to buy a capital equipment out there. So she shied away, and then she said, okay, let me lease the equipment. And again, the lease cost was like, a 5-year lease and, monthly payments, and no investor wants to get tied up to it. So the lease also did not work out. So the investor said, thank you, but no thanks. Then finally, what she did was she went to a supplier who agreed to rent out her the equipment for 6 months. If it worked, it worked. It doesn't work, it didn't work. And that reduced the entire cost down. And she went back to the investors, and the investors said, here you go, take the capital, let's do it, and let's take it forward. You have to learn how to be flexible. If you're not learning how to be flexible on situations, you will not know how to take an equity position or how to receive an input from an investor. There's another one, a healthcare office. So we had a company who wanted to have a good startup on the healthcare field. And, one of his core things was having an office in the prime location in downtown area. That's prime money. And then, when we looked at the whole cost, the cost of that entire office and furnishing and everything was like, 35-40% of the entire investment. And investors tried out. They said, oh, this is too much. And finally, we sent it back and saying that, listen, the idea is good, but, I think your cost of operations and the cost of capital is too much. We can't fund it. So he went back, and then he came back with another model, of subleasing an office. And we said, I don't think so, because that contract was again running for 5 years. And then finally, he came back, he went to a couple of doctors, and one of the specialist doctors who was an operating doctor, a neurosurgeon, he agreed to lease out his surgery office, his clinic office, because he's using between 6 to 9 p.m. in the evening, because during daytime he's in the hospital. He went and told the neurosurgeon, listen, you're not using the office between morning 9 to 5. Is it possible that I could take your office between 9 to 5 because it's not unused? And for 6 months, and if it works, then I can move out and whatever. So I just need some help. And the surgeon said, okay, I'm not using it, so take my office. And that's how he got funded, and he started, and he sold as a multi-million-dollar business. He grew up to almost 40-50 different cities. There's another one that came to us. Somebody said, this is COVID time, we need private planes, private charter planes and everything. And he wanted $80 million. Out of the $80 million, he wanted to spend about $45-50 million just on acquiring 20-year-old aircrafts, refurbishing them, and then putting them into use. And we shot it down immediately, because what? It is not going to work. Nobody's going to invest in an aircraft. But he was not flexible, and so he could not do it. There are two more cases I'm going to give you. One is known as Government Works, and the company closed down. So when the company came, they said, what, you're going to have an app to help all payments to government, like parking ticket or everything, from a wallet. And it's $1 billion idea. Anybody it's like the PayPal of the olden days, so if you're going to move into the space, you're going to be $1 billion enterprise. The investors went and told them, listen, why don't you listen to us? Why don't you just get one app, like a parking ticket solution? And then we move on to a municipality and see what you can do for the municipality before you come back asking us to fund your marketing campaign and funding program for the entire nation. They said, this is $1 billion idea. We don't want to go to a parking ticket and get logged in with only a parking ticket. And you know what? That company closed down. So Tom Herman was the president and CEO there. They funded their own capital, sold their own houses, but they could not get the capital to run it. Whereas another company known as OfficeNet from Latin America, from Argentina. So they started just like Staples of America. Staples is to the global viewers. The Staples is one of America's largest office suppliers. So they said, let's start OfficeNet in Argentina, and they started OfficeNet in Argentina. Within 3 years, they reached $20 million sales. And then they said, you know what, let us become the Staples of South America. Let's get funding and become a Staples of South America. And at the same time, when they wanted to expand and go into becoming the stable South America, the investors said, no, we don't want to back you up because, we don't think, we can become the staples of South America. The promoters were very independent. Andy and Santiago, they were very, fierce. They wanted to be very independent, but they listened to what their investors were saying, that we can't back you up to become staples of America. So what they did, they had an open mind. They moved on and they merged with, the other company known as, mm, uh, there you go. Yeah, Submarino. Yeah, they merged with Submarino. Submarino is one of the largest, CD suppliers like Barnes and Nobles of Latin America. So they merged with thing because they wanted to become the Amazon of Latin America. And today they are part of like the Amazon of Latin America, where Amazon has not penetrated to that level. So that company has grown 100 million, 300 million, $1 billion. So if you are open, you grow. If you're not open, if you're closed, you're not being flexible enough, and you can't take hard positions. So one of the first biggest blunders is not being flexible. You are an entrepreneur, you have to become flexible, and you have to listen to what investors are saying, listen to what others are saying, but then make up your own mind. The second one is risk mitigation. So we're talking about risk mitigation. We're talking about multiple levels of risk mitigation, and you're running a company. And we have seen this over and over and over again. Companies are willing, promoters are willing to become entrepreneurs. They are taking the ships, but they are not willing to understand what is the length of time. So if you're a captain of a ship, if you do not know it's going to take 100 days to reach from London to New York, in a steamboat or in a thing, how are you going to reach the destination? Do you know you have enough fuel? Do you know you have enough food on the ship? Do you know that there are storms on the way? What are you going to do? You need to know your business risk. How many of you have taken effort to understand what are all your business risks? Because an investor is going to look straight in and say, what is the risk with this company? Because nobody wants to lose their money. They're going to look at your company and going to say, is it a market risk? Is there a financial risk? Is there an operational risk? Is there a team risk? Is there a funding risk? Is there, an execution risk? What is the risk with this company? If you do not know your own risk, and if you expect the investor to find it, then you're not going to get funded. There's a whole bunch of risk out there. Alcor, we have done about an analytical AI program, and we've got about 40 different risk analysis that we have done. And we have seen that companies who have scored high on the risk analysis and mitigated the risk are definitely getting funded. 85% of the companies who have scored more than 85% of risk mitigation have got funded. And those companies are not got that are not the ones who are not getting funded. So it's important that you work on this and look at the risk mitigation. So one of the companies on risk mitigation, I'm going to talk about is Telepizza. You heard about Telepizza from our Spain. So Telepizza Pujal, he went back to Spain and he said, Domino's is making this in America, so can I do something similar in Spain? And so he set up this first, Telepizza venture in Spain. But what he did was he said, let me understand, before spending too much money on it, let me go step by step, understand all my business risk. And it was an instant success because, Telepizza opened his first shop. It was a huge success, but he didn't do it overnight. He went step by step. Almost a year later, he realized that in Spain, people like to come and eat a pizza and order another pizza. And then he also realized that people in Spain liked, the children to order the pizzas for them because the children liked to think. So he had a family room. He had also a family menu when he was advertising. So by the time he went to second year, he understood the risk, understood the interaction with the customers, built the operations team, and then step by step, he grew to a $300 million enterprise. And now it is bought over by a global chain. So what has he done? He understood, he took the risk, he investigated it, he spent money understanding the risk, and then he mitigated one by one to become a global thing. Today, it's working in 12 different countries. It's got more than 600 outlets. It's fantastic what he has done. Whereas when you look at other companies, we had another company known as Laurel and Wolf. Laurel and Wolf, it's a great company. It's what they did was they had an idea for online designer program, so that if you want to customize the interior design of your house, you have to just log on, and you can get funded, and you can see how to do that. So that's exactly what he was doing, an online designer program. And they wanted to take it forward, but they did not understand the market risk. They did not understand whether the customers really wanted. If all of you have houses, how many of you would actually go to an online service provider to give you a design for your house? Have you even tried it? No, they were too early for the market, or they did not understand there was no demand. So finally, after a lot of time, a lot of effort, Laurel and Wolf had to shut down. So what we are seeing over here is you have to understand what is your risk and how you're going to take it forward in a very, very calculated risk mitigation level. Because if you are not able to look at that in a risk mitigation level, then we are going to have a situation where we are going to keep driving down. Then we are looking at Think Labs. So Think Labs is another company that was in China. They got funded by SoftBank in the first run. But what happened is Think Labs didn't realize that over a period of time, they were not taking the risk. They were being very aggressive because they got funded by SoftBank. They said, let's do it. They're very aggressive. And then they did not get the funding after that because they were too aggressive. They missed the targets. They missed their financial goals. They missed the profitability, and they could not just move forward. So you have to invest time, effort, money to identify your business risk. If you don't do that, forget it. You're not going to get funded. You have to identify your business risk. That is so critical. As an entrepreneur, if you don't take time and money and to invest in it and find out your business risk, you are not going to get funded. Even if you get funded, you are going to get funded for some operation level that is not going to take you to the next level. Next is assumptions. You have to validate your assumptions. We have seen businesses without validating their assumptions. And we have seen companies go completely haywire without validating the assumptions. So one of the things about validating assumptions is, what are the assumptions in your business? When you're starting a company, all of you have great ideas, great business ideas. You want to start a restaurant, you want to go ahead and start an e-commerce company, you want to start a food company, you want to start a digital company, you want to start a digital wallet, an agri company. There's so many ideas. But unlike established companies, you don't have all the data with you for you to take a good decision. So what happens is you have to assume. But then if you don't go ahead and validate your assumptions, you are getting cooked, and you're going to get cooked with everything that you have. So you have to go and validate your assumptions. So how do you validate your assumptions? What do you have to do to validate your assumptions? So let's look at 2-3 cases to see which companies have done it right and which companies have not done it right. So most of you know about this company. Do you know about this company? Do you know what is this? This is edible cutlery. Okay. And I'm going to give you a small story about this edible cutlery, right? So Narayan Pisapati, he was the CEO of he's a CEO of edible cutlery, but he in 1991 he was doing environmental research, and he's based in Hyderabad, and he found out that the groundwater level in Hyderabad is a city in India, it's a well-known city in India. The groundwater level in Hyderabad was dropping down drastically, and he was saying, why is this groundwater level dropping down so drastically? I mean, why is it thing? So he went on to research, and he found out that it is because of the agricultural practices of the people, of the farmers. And what he further investigated and found out that farmers who used to be farming for millets moved on from farming millets into farming for rice. And rice needs 60 times more water than millets. and rice is, probably had little more better market value. So when farmers moved from millets to rice, which needed 60 times more water, so the water level started dropping down in the place. And also they had subsidized electric power, so they had electricity that was subsidized. And because of the subsidized electric power, what they did was they realized that, okay, fair enough, let us take this forward and let's move on this. And so they had the entire electric power that was subsidized, and because it was subsidized, they could just move forward on that. And they went ahead and, they did their farming. And this resulted in the entire collapse of the groundwater level. And then he said, how do we stop this? So he wanted to get back to millets. And then he had this idea, why don't we start edible cutlery, because edible cutlery used millets. And he made a video of that, and he got funded 12. He went for crowdfunding. He got, oversubscribed 12 times. He started the company, and, step by step, because of his assumptions validation, because of everything else, he was able to take it to the next level of that entire this one. And the company is doing very well. So what we are saying is, if you do your assumptions, market calculations, projections, team, everything, you are able to make a win. On the other hand, we have another company that was also in missed assumptions. We had a company known as Call9. Now, Call9 is is an app that if you need a medical doctor in an emergency, you don't call 911 in the US. And so it's a US based company where if you have a medical emergency in the US, what you do is you call 911, it goes to a police center, and they will send an ambulance immediately. I mean, that's how it is set up. So Call9 was, you press that app, and instead of going to 911, it goes into a medical doctor who's on standby, and he comes, they send medical doctors on video, and then also a medical doctor comes on standby. But what happened was, then the idea looked good because it was, cheaper, it was better, it was faster. But then the idea was good, but they assumed that everybody's going to download the app and immediately they're going to get business. What they didn't realize was this was going to be a catastrophic blunder, because people were hesitant of dialing this app, because they didn't want to go about doing that. They just didn't want to go about doing that app when they had a reliable 911, which was most secure, which they trusted for years together. They could not just go ahead and do, Cal9. So that's how, they went through this Cal9, and which was again going into a catastrophic blunder, because they did not do the assumptions right. So the challenge here is, if you don't get your assumptions right, you are getting cooked. You have to get your assumptions right. And that is very, very, very important. There's another company known as Area Insights. And Area Insights was a company that was also great. It was moving forward. It got a first level of funding. It was for looking for aerial search, so drones for search and rescue missions, and drones to look at bridges and see if any repairs were required. But after some time, they realized that that was not a huge marketplace for that, because the number of search and rescue missions are not that high in the market. And even if they're there, people are more relying on helicopters and human interfaces to actually do this. So that's how they're looking at that. So that's how they're looking at that and moving forward. So coming back to this one, so this is how they're looking at interfaces and human interaction for market flexibility and assumptions that are there. Then we're looking at cash burns. Companies misjudge cash burns. When companies are having cash burns and they're having issues with cash burns, they collapse. Miscalculate the cash burn is death by amateur hour. And if you are doing enterprises and production, if you don't have cash burn analysis to forecast correctly, you are collapsing completely. So you have to have cash burn analysis. So one of the things is we are seeing is you need to employ a good financial consultant who can come inside and forecast accurately. We have seen companies like Oryx Vision. Oryx Vision, was building sensors for autonomous vehicle. Great, because the entire world is going into autonomous vehicle. They were building the sensors for 3D depth analysis, and they were in the right place, right market. and they started raising capital, and they short, made a forecast, and they could not reach the forecast levels, and they burnt out of the cash, and the investors were not willing to fund them further, and they had to collapse. That is Oryx vision. And then we had Anki Inc., founded by three Carnegie Mellon Robotics Institute graduates. They had the software and the robots, and they said, you know what, we are going to come with cutting edge technology into this world, and we're just going to make a fantastic product. Unfortunately, after burning 182 million, they ran short of cash, and the investors said, hang on, we can't trust you any further. If you are not having good control of your cash burn and forecast, then the investors lose confidence to fund you further, period. That's it. Because you know what? It's like a pilot, right? You're on a plane and you got a fuel, and in the fuel, if you're just going to go inside and you're going to fly through, if you're not getting the right distance and the right forecast, then you're midair, you're going to be out of fuel, and you have two choices. Either some other plane comes and gives you mid-air refueling, or you crash down. So remember this, you have to forecast your cash burn correctly. If you forecast cash burn, then you're not going to make it right. So that's very, very, very critical. Then benchmarks. Most of the companies we have seen is benchmarking against established companies. And if you benchmark yourself against established companies, you are inviting failure. Why is that? Because imagine a newborn baby or a young baby of 1-year-old baby is trying to run a race with a 20-year-old adult. Can he ever win? No. So established companies, 10 years, 15 years, they have different metrics. Don't take your benchmarks and compare with benchmarks of established companies. You have to come with your own benchmarks and explain to investors why your benchmarks are different and why it is adapted and suited for you, because that's what's going to make a difference in the way you perform and the way you do it. I've seen this over and over again. Good startups, great ideas come with performance benchmarks of established companies, and then they try to compare and say, we're going to do this, we're going to do that. Let me tell you, you're going to fail, because you cannot. It's like a baby trying to run with an adult. You can't run. There's no logic, there's no science, there's no way you can do it. And time again, you have to do this benchmarking against your type of startup, your type of field, your type of this one. You have to innovate, come in, and then say, this is how I'm going to perform. So investors are going to look at you, will come back saying, yeah, I got you. You got it right. Then I've seen time and time again, business blunder is financial sustainability. Lifetime value of a customer has to be greater than cost of acquisition of a customer. This week itself, I've been in a couple of calls with potential companies who want funding, and half the time I see the cost of customer acquisition is not even calculated. They have not even understood what is cost of customer acquisition. They're looking at, the gross profit is greater than the fixed cost. Q into P minus C is your gross profit. Number of units into your gross profits is greater than your fixed cost. They understand, okay, as long as I'm making profit, it's fine. Your profit has to be more than your fixed cost. That's one. And two is your lifetime value of a customer has to be greater than the cost of customer acquisition. If you've not worked out your cost of customer acquisition, you are inviting blunder. You have no choice but to go and work and get your cost of customer acquisition right. Because if you're spending more money to get your customers on board than the lifetime value of your customer, that business is not going to get funded. You have to go and pivot. You have to go and see what has to be done next. And then not investing time, money, and sweat equity for capital raise. I've seen over and over again, sometimes entrepreneurs. I was in a call with somebody in Bangalore, a young man who is having an idea for a private, piracy filter for, or a private filter for, internet browser. And he was so excited, and he said, you know what, I'm going to be the next Google, and I'm going to be all that and all that. And then I asked him, how are you going to be set up? And he said, well, I'm going to be set up because, I have got full control of my company. I'm a 99% shareholder, and my mother is the 1% shareholder, and I got nobody else. And I'm only going to give you 2% equity because my company is worth $1 billion. You have to invest time. You have to give sweat equity advisors. If you got a board of advisors, get the best advisors on board, the best that you can. Give them sweat equity. Give sweat equity to your employees. Get the best employees you can. Keep 10% of your company for just sweat equity of your employees, because you need the best possible people to help you launch. This is the time. It's like a rocket ship leaving leaving Earth. It is so critical that, at the base of the Earth, when assets leaving the ground, it needs a maximum thrust. Once it reaches 100 kilometers in the air, then it starts operating on its own. For you would know that the entire energy to go around the circumference of Earth in the air is lower than the lift from the ground to the entire 100 kilometers to 200 kilometers up in the air. So you need the best people. You need the best employees. You need the best consultants. You need everything at the time of the launch. So you have to invest time, sweat equity, and everything, because only then you're going to get this thing. This is essential work. Don't ignore it. Don't think that you just got an idea and now everybody's going to come running to me. It's different. Then finally, I want to talk about, investors and investments are different. Not all investors are equal, and not all investments are equal. So you have to look at what is the best fit for you. Because if you got the wrong investor, you're not going to win. You have to have the right investor, and you have to have the right investments. Both are critical, because one investor might be looking to grow your company, and one investor is looking to make money out of your company and go. So you have to look at who's growing and who is not growing and how you're going to do it. That's critical. So you have to look at that and choose your best fit. So I'm moving towards the next final session, because I always want to conclude with the session that I learned from Harvard Business School from Professor Clay Christinen. So do you plan for failure? No one plans for failure. You don't plan for failure. I don't plan for failure. None of us plan for failure. So then why do we fail? Right? How is it that, we fail if we don't plan for failure? Right? So failures in business are well documented. You have to learn those stories. You have to research. As an entrepreneur, you have to always learn this, because you see, there are two critical things an entrepreneur needs to know. One is, if you want to be successful, you have to be granular. You cannot be superficial. Superficiality is not going to give you mastery. Granularity is going to give you mastery. You have to get into the details. And here we are talking about failures. Are they man-made? Yes, they are man-made. And can you avoid? You can avoid. Failures in business are well documented. Let's look at two cases here. BlackBerry. So did the CEO of BlackBerry phone, everybody knows in 2000, they were they were the market leaders. And did the CEO of BlackBerry in 2001 tell his board, hey, ladies and gentlemen, we are the market leaders now. In 10 years, we'll have a plan to bankrupt the company? No. Did he ever think that 13 years later, this company will go bankrupt? No. Then why did BlackBerry, which had the best guys, the best brains in the world, become bankrupt? Nokia, the CEO of Nokia in 2004 tell the board, hey, ladies and gentlemen, in 2013, we'll have a great strategy. In 9 years, I will bankrupt this company. No. So why did these companies go bankrupt? Well, the answer is very simple. If you read this book, How Will You Measure Your Life, you'll understand it very clearly. But in a 1 minute sentence, you have to invest short term and long term. These companies were investing only in short term, next 3 months, next 6 months, and they could not see more than a year ahead. If you're looking down and walking, you're just going to collapse. You have to look down and you have to look up. You have to look today and you have to look into the next 10 years ahead. And that's how you take your decisions, whether it is your business or whether it's your personal life. If you don't invest in your children today, 20 years later, your children are not going to be successful, and you'll be saying, what went wrong? Because you have to take time to invest in your children today. If you don't invest in your spouse today, 15 years later, you'll have a divorce and you'll say, what went wrong? Well, you've not invested the time in your spouse. And the same way, you have to invest time in your business now, but also plan to invest in the future as well. So you have to plan the vision ahead and the vision now. It needs a combination of both. That's what's going to make a very successful long-term business. Invest short-term and long-term. And as I move to my concluding slide, what I want to talk is big idea. Someone gives you money, you build it, overnight success. That's what everybody thinks it is. Whether it is Elon Musk, Steve Jobs, everybody, or Bill Gates, or Mark Zuckerberg, everybody, it's not like that. You start, you're insecure, you work really hard, get lots of help, life happens, you fail a lot, you are focused, you invest short term, long term, you're tenacious, and you are granular, and you become successful. And you become successful. That's what makes you successful. So you have to look at what you have to do, understand the risk of your company. That's so critical. If you don't understand the risk, you're bound to fail. There's no choice here. There's no choice. You have to understand the risk of your company, understand the gaps, impact of risk. How do you mitigate the risk? How do you improve the probability for success? Attract global investors with low startup risk, soar the skies, and conquer the world. And thank you all for joining today. And I have to thank my special friend, Mark Fraser, my Harvard buddy, who's brilliant in putting strategy into execution. He has done it for so many companies. If you have got a great strategy, you want to execute it, you have to go to Mark, because Mark is the one who's going to be there, who understands it. He has done it for so many companies. He's the one who helped me put this presentation together. Thank you, Mark. If you're listening, and I have given Mark's contacts there, his number, as well as his LinkedIn contact and his email ID, you can reach out to him. And thanks to the entire Alcor team for putting this together in a short notice and working this right through. Thank you all.
Thank you so much, George, for a wonderful session. Okay, it really creates the energy was excellent. If I can feel it, I'm sure that everybody in the room has already felt it, and it was just super. Well, I have certain questions which we have got from the live platform. One of them is there any formalized model tool to analyze the risks?
There are tools to analyze the risk, and the tools are in alcorfund.com. You have to go to Alcor Fund, and you can see the tools there. And there is an AI tool that we use to look at risk, and it's got about 40 parameters, and you can look, and it's a 15-minute program that you have to enter as promoter, and it analyzes it. Then it goes back to our analysts who are going to analyze it with your due diligence document, and then you get a full report that gives you an idea about what your risks are, what are the gaps, and how you can actually take charge of it. Yeah.
Right. Just one more question. So, what is the minimum and maximum ticket size for VC funding with Alcor?
The minimum is about 200,000 to $300,000. It is not through Alcor. The minimum will come through Alcor's networked partners, and with Alcor is about 20 million and about.
Great, thank you. And one of the next question is, how do I know if my business or my product is investable?
If your risk mitigation score is more than 85%, then you're 100% guaranteed to get investment. I mean, I've seen companies getting more than 85% getting the investment. I've seen this over and over again.
All right. Then there is one more question. What will be least what the least expect?
I didn't get you. I didn't get you. What was that?
It was what will be least like about the due diligence process? What is the least what you will expect? What is the minimum criteria which you expect out of the due diligence process?
We have got a due diligence checklist. It's, you'll have to work through our due diligence team, but usually it's about, we have got about, criteria for execution and rest of it. Yeah.
How will you value my company?
Valuation is based on your idea, the industry, the metrics, the peer investments done in the same space, and also your growth plan, your execution plan, your team. There's a whole bunch of metrics that we look at valuing your company. It could be DCF valuation, it could be peer, it could be a hybrid, it could be a multiple valuations. Basically, we're trying to see what's the best value you get and best value for us as investors.
Great. So I think we have all the questions answered as of now, George. And once again, thank you so much, everyone, for joining us. And I'm sure that it will help you in your futuristic goals to be achieved. Thank you so much, George, for this wonderful session.
Thank you. Bye. Thank you. And you have my contact information as well. So in case you want to reach out to me, okay?